Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So kicking things off, here is the least surprising viewpoint on this week's FOMC decision as captured in an FT headline. Trump lashes out after Federal Reserve keeps interest rates steady. Now recall that at Davos, the president let the world know via larger-than-life video that he is demanding that interest rates drop immediately. I guess Chair Powell did not get that message. Okay then, over to you, Scott Besson. All right, this week our three things are: 1. Blackstone Blowout. What's the read across? 2. GDP miss. Peel that onion and you'll find some good and some not so good. And 3. Default forecasts. Our own Eric Rosenthal will tell you where we're headed. All right, let's dig a bit deeper. Blackstone's blowout. So the largest alternative asset manager in the world is back hitting on just about all cylinders, with solid returns in private equity, private and liquid credit, and multi-asset investing. Real estate, representing 19% of capital deployed, was the lone laggard. Overall inflows, investment activity, and realizations hit their highest levels in 2.5 years. Distributable earnings jumped 56% year on year, driven by record fee-related earnings. The results are important because of the read-across that Blackstone provides into the health of the broader economy, credit markets, as well as the effectiveness and efficiency of the financial system. Remember, from our perspective, the U.S. financial system, decentralized and markets-based, public and private, bank and non-bank, is the world's best at getting capital to its most productive use. It's not perfect, it is difficult to regulate, but it beats the alternatives. And the rise of private markets, private credit in particular, have built a much improved shock absorber compared to the banks, which in times of market stress, cede control to its regulators and their differently aligned motivations. All right, on to the points made on the earnings call where there is insightful read across. As for the backdrop, CEO Schwartzman stated that we're moving into an environment where we see consequential tailwinds for our overall business. He addressed two headwinds, inflation and policy uncertainty, and gave comfort on both, saying with respect to inflation that based on our expansive portfolio and our proprietary data, the U.S. is continuing on a path of disinflation, albeit at a more moderate pace than before. In terms of policy leanings of the new administration, he believes the direction of travel fundamentally is toward policies that are pro-growth and pro-deregulation, which ultimately should be quite positive for our business. President John Gray summed up the quarter this way: the combination of a healthy U.S. economy, historically tight financing spreads, greater debt availability, the prospect of a more business-friendly regulatory climate, and importantly, accelerating technological innovations have given us confidence to deploy capital at scale. He provided interesting color once again on the illiquidity premium in private credit, highlighting that the firm placed or originated $46 billion of A- rated credits on average for our private IG-focused clients in 2024, up 38% year over year, which generated nearly 200 basis points of excess spread over comparably rated liquid credits. Finally, he addressed real estate, which has struggled under higher interest rates, a stronger dollar, as well as secular changes in the industry, most notably in office buildings where valuations have come down from between 50 and 70% in his estimation from their peak. A year ago, the firm said real estate values were bottoming, but the recovery would take time. A year later, they are firm believers that a sustained commercial real estate recovery is underway. They point to debt markets that are vastly improved, new supply is down dramatically, while demand has been resilient, and they continue to deploy at scale. All right, on to our second thing, growth slip. So we've grown accustomed to better than expected strong economic growth. Now, using the Fed's estimate, 1.8%, for longer run growth in real GDP in the U.S., we see that over the past 10 quarters, growth has exceeded that 9 times, averaging 2.9%. We continue to remind folks that this is not normal. This is the result of surging wealth, driven first by unprecedented fiscal and monetary accommodation during the pandemic, and more recently by inflated values in investment and residential real estate markets. So today's print for Q4, 2.3% versus the estimate of 2.6%, caught my attention. And by the way, congrats to the Atlanta Fed and its GDP Now model, which called the outcome. Interestingly, for much of December, the Atlanta Fed's dynamic estimate for Q4 was north of 3%. Now, underneath the headline number, we find that the 4.2% jump in consumer spending essentially drove all of the increase and likely impacted inventories, which experienced a significant drawdown. Now, some have speculated that the growth in consumer spend might be households anticipating tariffs and pulling forward durable goods purchases. My own view is that only an economist could come up with such tomfoolery. I don't know what kind of crowd you're hanging out with, but in my circles, exactly no one has pulled forward purchases to get ahead of tariffs. In any event, the consumer continues to spend. Maybe they too are driven by animal spirits post the election. More worrisome is a 0.6% drop in private fixed income, the first drop since the fourth quarter of 2022. Within this category, business CapEx fell off the table, down 7.8% from the prior period, although this was probably impacted by the Boeing strike. Now, excluding aircraft, investment in equipment still fell 2.4%. A bright spot was home building, which bounced to the positive at 5.3%, although the recent rate rise will likely dampen that trajectory in Q1. While a growth-fueling inventory rebound might be in the offing for Q1, we're not so sure the consumer strength will remain as robust. Wage growth is slowing, credit availability for lower-income households is tapping out, consumer confidence is slipping, and the, quote, no-buy 2025, unquote, movement is apparently taking root, or so say influencers, according to Google. So pulling it all together, our view is that we are slowing back to normal, although we do expect some bump to growth in 2025 due to Trump's deregulation push and the unleashing of animal spirits. Nevertheless, higher for longer rates are leaning on interest-sensitive sectors, most notably housing, and wage growth is slowing. Still, this remains a highly constructive backdrop for credit heading into 2025. All right, on to our third thing, the 2025 default rates update from KBRA Analytics. Joining me, as always, is Eric Rosenthal, who tracks defaults across high-yield bonds, broadly syndicated loans, and private credit. Eric generates our default forecast as part of his work with KBRA DLD, our direct lending news and analytical platform. Eric, welcome back to the podcast.
Thanks, Van. Excited to be back.
So before we get into your 2025 forecasts, what was the most surprising result looking back at 2024?
So I was shocked that broadly syndicated loan default volume topped 2009's record, eclipsing $82 billion. Entering 2024, I expected default volume would exceed high yield, and by the biggest margin ever, by roughly $20 billion. Well, that ended up at $58 billion. While the vast majority of loan issuers defaulting were forecasted, there were some projected either for smaller amounts or were expected to occur in 2025. This resulted in 2024's 5.6% dollar rate, above the initially anticipated 4%. Now, as a comparison, high yield landed at 1.7%. While this was lower than the originally projected 3%, we frequently discussed how a sub-2% path was obtainable, so on that front, not a surprise.
All right, I got all that, Eric, I think, but to me it's sort of counterintuitive that BSL's default volume topped 2009's. What's driving that?
True. So the economy was better than expected, but the higher cost of capital resulted in reduced liquidity that exposed and tested both deficient business models and inappropriate capital structures.
All right, so what else struck you as particularly noteworthy about 2024?
You mean besides your Eagles defense becoming good?
Oh, hold on there. Fly, Eagles, fly. All right, but we'll let that go for now. That's a shot across the bow. We're used to it. Go on.
How about high yield average implied recoveries ending up a smidge higher than broadly syndicated loans?
All right, that's better.
This bucks the historical trend of high yield finishing roughly 20 points lower than loans. These results feel more like an outlier, though, due to a relatively small sample size combined with numerous distressed debt exchanges, which typically have higher recoveries than bankruptcies or missed interest payments.
All right, now let's turn to direct lending, which made headlines all year. Default rates continue to be well behaved despite all of the capital that has flowed into this space. So walk us through why you think that's been the case.
The 2024 direct lending issuer default rate stands at 1.9%, but won't be locked until BDCs report their fourth quarter results over the next several weeks. Now, we are anticipating several defaults via restructurings, which could put the rate real close to our 2.75% projection. Now, you're right about direct lending performing well. We attribute this to strong lender protection, such as documentations, covenants, as well as active management by lenders. For 2025, we forecast a 3% rate. Now, this slight uptick reflects a growing list of borrowers on default radar and a slight easing of fair value marks in our index. The radar has grown significantly and now accounts for nearly 8% of the KBRA DLD Direct Lending Index. Furthermore, overall fair value marks slid roughly 30 basis points over the past year.
All right, understood. Now, how do you think about direct lending implied recoveries in 2025?
So we believe that implied recoveries will fall slightly, landing at roughly 48%, which is down from 53% in 2024. Now, the lower projection is based on average fair value marks of 58% for the red issuers on default radar. These same issuers were about 10 points higher just 6 months ago, and that downward trajectory, that should continue as defaults eventually happen.
All right, so turning back to liquid credits, how do you view broadly syndicated loans in 2025? Could we be looking at another default record?
No, I think we are safe from even approaching last year's record. Now, we're calling for $58 billion of volume, which equates to a 3.75% rate. Now, that total is more in line with the 2020 and even 2023 amounts than from, say, 2009 and 2024. The rate drop reflects a reduction in red loans on the default radar. From a count standpoint, we anticipate roughly 63 defaults. That's compared with the 86 that we saw in 2024.
All right, and how about high yield? Is that still going to be low in 2025?
Yeah, so we project roughly $32 billion of default volume, which equates to a benign 2.25% level. Now, while that is slightly higher than last year, that is below the historical levels. In fact, the potential for the rate to mirror last year's 1.75% rate, that is still in play. And the reason? There are only 21 issuers on our red list entering the start of this year. And those with the largest outstandings, they'll likely engage in smaller size distressed debt exchanges.
All right, I got that. Now, finally, any new developments from your team?
Yeah, so we got two big developments in two different markets. First, in direct lending, we now publish the dollar default rate by volume. And second, in BSL, we launched the KBRA DLD Leveraged Loan Index. Noteworthy is that outstandings are nearly $1.5 trillion across 1,200 rated issuers.
All right, terrific. So I have to ask, what's your 2025 default forecast for direct lending by dollar?
So we're forecasting a 1.25% rate by volume for 2025, and that would be down from 1.8% in 2024. And that's, of course, pending any additional fourth quarter restructurings. Now, keep in mind, Pluralsight, that drove the dollar rate in 2024. So while we do forecast more 2025 defaults, none have BDC holdings in the index that even equal half of that issuer.
That's a terrific update. Thank you for that, Eric, across both 2024 and what you're expecting for 2025. So before we go, remind our listeners where they can find your research.
Sure. So you can follow KBRA DLD on LinkedIn, and to receive our defaults weekly in your inbox or access all our reports on liquid credit and direct lending, contact Nikki Messino at niki.masino@kbra.com.
All right, Eric, that's a great wrap up. Thank you very much for your forecast. We'll look forward to how it all plays out in 2025. So there you have it. 3 things in credit. 1, Blackstone Blowout. The backdrop to credit is highly constructive. 2, GDP miss. The fall off in CapEx is worrisome, but the consumer remains powerful in the aggregate. And 3, default forecasts. A still strong economy should keep defaults well behaved. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.